When creating the script for this presentation, it turned out to be nearly 2,500 words and 9 pages long. This video is a shorter summation of what I wanted to talk about. For those that want a deeper dive in more of a podcast-style dialogue, check the description for a link to that video if you want a little more details. I will also include a link at the end of this video.
Should you pay off your debt? Or should you invest for the future? It's one of the biggest financial tugs of war out there. Where should your extra money actually go? Well, today, we're going to break it all down and find some real clarity.
So what is the right move? Do you go all in on your loans, just totally laser focused on getting that number down to zero? Or do you kind of play both sides, chipping away at the debt while also building up your investments? This is a super personal decision, and you'll see the best path isn't always the most obvious one. And this, right here, really gets to the heart of it. For some people, it is all about the cold, hard numbers, finding the most efficient, mathematically perfect path. But for others, it's about emotion. It's about the motivation you get from seeing real, tangible progress. The good news? Neither approach is wrong. And we're about to explore strategies that work for both sides.
So here's our roadmap for today. First, we're going to cover some essential ground rules. Then, we'll dive into the 2 classic repayment paths before we explore some pretty clever hybrid approaches. We'll even look at how the long game of inflation can be your secret weapon. And it all leads to that final big question. Which strategy is right for you?
Okay, so before we jump into all the different methods, it is absolutely crucial that we cover a couple of key precautions. Think of these as the foundation for any successful plan you're going to build.
First up, do a quick check of your loan documents. Now, it's pretty rare, but some loans actually have penalties for paying them off early, so you just want to be sure. Second, and this one is the big one, you have to commit to stopping the cycle. This means making debt elimination your primary mission and hitting pause on taking on any new debt. It's all about redirecting that financial energy toward your goal.
All right, let's get into the 2 most popular strategies out there. You've probably heard of them, the debt snowball and the debt avalanche. They approach the exact same problem from 2 totally different angles. And this is where we see the 2 big philosophies clash. The snowball method, it's all about psychology. It's engineered to give you quick wins to keep your motivation fired up. The avalanche method, on the other hand, is pure math. Its only goal is to save you the most money on interest over the long haul. So, motivation versus math. That's really the core choice here. So, how does the snowball actually work? Well, it's pretty simple. You list out all your debts from the smallest balance to the largest, and you completely ignore the interest rates for now. You keep making minimum payments on everything, but you throw every single extra dollar you have at that smallest debt. Once it's gone, bam, that's your first victory. Then you take that entire payment you were making and you roll it on to the next smallest debt. And that's how you create, well, a payment snowball. Now, the avalanche method is for all you numbers people out there. Here, you list your debts by interest rate, highest to lowest. Again, minimum payments on everything, but all your extra cash gets poured onto that high-interest monster. Like a credit card with a 20% interest rate. Now, it might feel a little slower at first, especially if that debt has a big balance, but this approach guarantees you will pay the least amount of interest over time, period.
But what if that feels a little too black and white? What if you want to pay down your debt and start building wealth at the exact same time? Well, that is where the hybrid strategies come in. Let's take a look at how you can do both.
So, the first hybrid is to pay off and save. You just continue your regular debt payments, but any extra money you have goes into a totally separate high-yield savings account. The magic here is that you get to watch your savings balance grow at the same time your debt balance is shrinking. It's a huge psychological boost. Then, when your savings gets big enough, you can decide to just wipe out a debt in one fell swoop. You're building wealth and tackling debt all at once.
Our second hybrid is a little more advanced, pay off and invest. Now, this is for folks who are comfortable with the normal ups and downs of the market. The idea is to put your extra funds into stable, dividend-paying investments, like a broad market ETF, which is really just a big basket of different stocks. You then take the dividends, those little cash payments you get from the investments, and you use them to make extra payments on your debt. Your money is literally working to pay off your loans for you.
So what kind of investments are we talking about here? The goal isn't to chase some high-risk, high-reward stock. Instead, you'd be looking for stable assets that have historically provided a pretty steady dividend yield, often somewhere in that 3 to 4.5% range. This can create a reliable little stream of income to help you accelerate your debt repayment.
Okay, let's shift gears and look at the bigger picture for a second, especially when it comes to long-term debts, like a mortgage.
There's a really powerful force at play here that a lot of people overlook. It's called inflation. And believe it or not, it can actually work in your favor.
So let's just imagine you have a fixed mortgage payment. Today, it's $2,000 a month. That number is locked in for the entire life of the loan. It will never, ever change.
But here's the real question. While the number itself stays the same, will the value of that $2,000 stay the same? I mean, as prices and wages rise over decades, what do you think happens to the real burden of that fixed payment?
The result is fascinating. If you assume an average annual inflation of about 2.5%, then in 25 years, that $2,000 payment is going to feel like you're only paying about $1,078 in today's money. Inflation is quietly eroding the real cost of your fixed debt, making it feel lighter and lighter over time, especially as your income is likely to grow too.
So, we've covered the classics, we've covered the hybrids, and we've looked at the long-term view. How in the world do you choose? Well, it all comes down to one critical thing.
And that quote says it all. Ultimately, there is no single best answer for everyone. The most mathematically perfect plan on Earth is totally useless if you can't stick with it. The real goal is to find a strategy that just clicks with your personality and creates sustainable momentum. A plan that keeps you going, month after month.
So whether you go all in on debt, invest alongside it, or mix it up, the key is just to take action. Think through these strategies, figure out what fits your personality, and build the habits that are going to propel you forward. The best plan is the one you won't give up on. So, what's your next step going to be?